And HUB24 released its first half results yesterday with profits and revenue both up on a year ago. It comes as the company is set to complete its part takeover of Easton Investments. To get the lowdown on the results, we are joined here in the studio by Andrew Alcock, HUB24 CEO. Welcome. HUB24 provides the platform, Easton provides the advice. Is that the strategy?
Oh, look, Easton is one provider in the marketplace that provides advice. We're not actually wanting to be an advice provider. Our investment in Easton is about working with an industry leader to build technology and services that we can roll out, not only to Easton but to the broader market, to reinvent the advice model, because I think, quite frankly, Australia is left with a situation where the banks are exiting and the infrastructure to support good advice for Australians, where demand is increasing and supply is decreasing, requires an investment. And we're going to do that, but we wanted a partner to do that with.
So Easton is going to go and help provide that platform to go and potentially go and attract a whole bunch more of advisors. Is that the plan?
I would expect that's their plan. We're wanting to provide some technology to them that will allow them to sharpen their value proposition. We wanted to, I suppose, have an anchor client that justified an investment for a part of the business and a part of the market that needs to be rejuvenated.
Well, this is probably a bit of a side issue, but with all the issues of game stocks, retail investors are pouring in that never entered before. I would hesitate to call that they need advice, but they certainly need some sort of investment advice on what is speculative and what is true investment model. You would be definitely the true investment longer term strategy model, right?
Oh, look, we're HUB24 essentially is an investment platform business where people, we encourage people to have an advisor and think about investing for the long term. We're not necessarily a trading platform. There are those business models in the marketplace, but we're really about meeting the needs for the population and for Australians who are looking to retire, making sure they have great advice and great outcomes. It's about us adding value to that nest egg rather than just administering it. How can we increase the outcome for you over the longer term?
Andrew, in your latest results released yesterday, profit increased nicely and a lot of positive feedback from the broker community. That's despite a lot of margin pressures at the moment. How did you manage to go and navigate that kind of environment and succeed?
Oh, look, it is a difficult time. Interest rates are low. That affects part of our revenue stream, but we're growing so strongly that we're able to actually compensate for that. So the growth has been above expectations, and in that regard, volume brings about increases in revenue and profitability. The margin pressure is largely about the RBA rates. We had great cost control. We did that deliberately moving into this year. We thought we don't know what's going to happen in this environment. Fortunately, we've done better than we expected, so it's now time to think about how we invest again for even further growth.
That was my question. So what's next on the horizon? Another acquisition?
Look, we're actually in the middle of 2 or 3. So we finished the Norbernet one in November. We have the Eastern one that's underway, but we actually take control of Xplore Wealth next week as well. Federal Court approved the scheme of arrangement last week. So from our perspective, we want to take the best of those 3 businesses and expand our offering in the marketplace and really make a difference in terms of what we offer today, different segments and different channels. We think there's a huge opportunity to disrupt ourselves and disrupt the market, which we also intend to do with our technology play as well as our platform services.
So the rollout of services is going to be one of those key things. I know that you noticed your funds under administration target was upgraded. That's going to be part of that service offering that you can go and provide?
Look, it's a part of our normal platform, David. So we looked at where the guidance we gave last year. We've effectively said HUB24 thinks the confidence in our own business from the statement we made 6 months ago. We've added roughly $5 to $6 billion to our own projections, let alone adding Xplore and the other acquisitions. We're growing rapidly. We've got a great pipeline. We're yet to launch 2 institutional private labels, which is a new part of the market for us. So all the signs are good for us to continue to go. And we were awarded Australia's best platform in the week. So from that perspective, winning that award and the standing we have in the marketplace, we're very confident of growth moving forward.
Who would you say is your biggest competitor in this space?
Look, we've typically competed against the incumbents. There are 2 specialist platforms making a difference in the marketplace, ourselves and Netwealth.
Okay.
When it comes to the rollout of a variety of, when it comes to, you've made a lot of acquisitions at the moment. With the synergies that you can go and get from that, the cost out, you talked about cost control. What more can you go and do, or have you satisfied that you've done all you can do in that space?
From our point of view, our business is very scalable. I think the strategy right now is, and we're not looking at synergy plays from the acquisitions, our lens on these acquisitions is about how we can take services to market and get the best of both customer sets with both product sets and get, if you like, that cross-sell, that cross-pollination. So our lens for the integration is not about cutting costs. There is a synergy benefit, it's baked into the case. It's about how we can go to market and make a difference. Particularly with technology, single view of wealth, being able to seamlessly see custodial and non-custodial assets, so off-platform, on-platform assets at once. There's a demand from that from a client point of view, and we think the future is about integrating third-party streams into that as well from a technology play, apart from our core platform business. That's what our focus is.
Just from the broader macro perspective, when it comes to the funds management and platform sector, what is going to look like in the years ahead? We've seen a lot of divestment from the banks. Is there going to be that grab for a market share that's going to continue?
Look, I think you've got a playing field where you've got a couple of people who are going to excel and win. Until the banks or others or the people who buy those businesses understand their strategy and make the investment, there's a big gap in the utility that we provide versus the incumbents. So I think that you've got a great opportunity for us. We have 2.1 or 2.3% market share in a market, yet we are the second largest in terms of flows, and we're tiny in terms of our current FUA. There's a long way to go, and there's no signs of competitors really getting their act together in terms of having a real proposition that would actually challenge the model.
Well, just a quick one from me, and then we'll wind up. Just to put myself, like, I'm on HUB24 because my financial advisor put me on. So your financial advisors will be owned by the HUB group, or are you just making sure that you're on their horizon in terms of client recommendations?
We're not actually wanting to own advice or advisors or their licensing. Our investment in Easton is a shareholder because we believe in what they're doing. We think there's a great opportunity for them to actually fill a gap in the market. We want to provide technology to that. Right. So definitely we work with all advisors and all licensees in the marketplace with an open architecture choice-based model, and I've got to congratulate you, you've got a great advisor.
Thank you very much, Andrew Alcock, CEO of HUB24 here in the studio. Thanks so much for your time today.
Thanks.